Hello and welcome. Today I'm sharing my trading experience, what trading is all about, some of its complexities, and how your approach should be when day trading. So if you could like and subscribe to the channel and stick around for the full video. Technically, indicators are inherently lagging, so they cannot be relied upon their own. Most new traders start with indicators. That's the first step into day trading. In my first 2 years in trading, price actions didn't matter to me because I was relying on the random set of the lagging indicators to make the decisions for me. The truth is, I was being lazy, hoping that I'd stumble across some magical combinations of indicators that would make me wealthy. I was just making decisions because a few dots and lines said it was time to buy or sell. But to rely 100% on them without first learning how to read price actions is a major mistake. Don't get me wrong, I'm not saying all indicators are bad or that traders who use them are wrong to do so. I also use trading indicators, but price actions comes first. Before you apply any indicators to the chart, you first need to understand price actions. Even if you feel that indicators are the way to go, that's okay. Just be sure to spend some time learning how to read price actions. It will help you in the long run even if you decide to use indicator-based strategy. If the trade doesn't let you sweep, you are not trading correctly. A simple rule you should apply is to think about your sweep. If you are able to place a trade, set the approach stop loss and take profit orders in your platform and then go to sweep. This is the trade size that fits your risk profile. If, however, when you place the trade, you find it difficult to sweep, you find that you are always thinking about the trade while always from your computer, that you feel the euro to constantly check your shampoo, then the trade is too big. That's the common mistake. So when people are new to the trading, they tend to feel the pressures throughout the day, and especially when the trade is opened. You need to reduce your trading to sweeping point, the point at which you can place the trade, accept the risk, and have the peaceful state of mind. Although trading risk is important, your emotional and mental health risks are more important. The first and the most Although trading risk is important, your emotional and mental health risks are important. The first and the most important way to control stress level with regard is to trading to control your position size. You will find yourself remarkably less stressed if you keep your percentage at the risk each trade lower. Always watch more than one time frame. Zoom out to see the bigger pictures. Day trading is You will find yourself remarkably less stressed if you keep your percentage at the risk on each target level. As always, watch more than one time frame, zoom out the bigger pictures. Day trading is considered to the risk alternatives to more traditional investing or swing trading. When traditional short time frames, it is enough to simplify analysis one time frame. Sometimes they is very little title to catch the perfect moment to enter, and if you are late even a little bit, you won't be able to take advantage of the picture movement. If you see a gold target on the 15-minute chart, see how it looks on the hourly chart and 4-hour chart too. Zoom out to see the bigger pictures. Sometimes the opportunity may be less obvious on the smaller chart time frame and more obvious if you zoom out and look at the biggest picture, and vice versa. Sometimes a move on a 10 minutes chart can look so crazy, but when you step back, it's very minor when viewed on a daily time frame. Eventually, market on different time frames will help confirm a trend and make a better informed decisions. Never make a trade change your mind for the little to no reason and take it off. Here's the familiar experience. You analyze a chart for some times. You see the decent trade. You pull the trigger, confident that your analysis will pay off, and after 5 minutes, when you are down few points, you close your positions. When day trading, emotions will come from market noise coming your way. Whatever makes are in the uptrend or the downtrend, you will witness a lot of the noise. And noise can impact your trading strategy and decisions. So you must filter it to keep your emotions under control. The lesson is always give your trade enough time to come good. If you're often engaged in emotional exercises, will only destroy your confidence and eat into your profits. This doesn't mean you can't change your mind when new information comes in. If a support level is broken, for example, a huge pin bar forms on the high volume. This should be all considered in your plan. Always questions yourself as whether your decisions are emotionally driven or are backed by the technical or fundamentals. Learn all you can about the Cayley formula. This is the mathematical answer to how much you should risk on the target. The reality is that even widely profitable systems will go bust if your risk is too big. The Cayley criteria is an advantage money management tool that helps you work out how much money you can risk on each new trading positions based on how well you are done with similar traders in the past. Calculating the Cayley criteria is relatively simple and relies on two basic components: your trading strategy, win percentage probability, and its win to lose ratio. They will help you to arrive at the number called the Cayley percentage. This gives you a guide to what percentage of your trading accounts is the maximum amount you should risk on any given trade. Cayley formula is probably the best money management tool for judging position size and risk tolerance in trading. You don't need to trade if the market is quiet or behaving straightly. Just wait it out. If you find yourself jumping into the low conviction traded because you can't find anything better, the most likely reason is that you need to do more work. Spend less time working at charts and more time reading, backtesting, and analyzing. If you take more trades that your strategy distance, that's a warning signs. This is often the result of boredom or the lack of disciplines. Since these trades occur outside of your training plan, they are less likely to perform well. So trade what your strategy dedicates. If the market is quiet or the chart entry conditions are not there, just wait out. Any opportunity always comes along. You only need a few big trades to have the green week. Learn to plan and structure every trade so that you know what to do in the eventually. You need to make the specific plan regardless when you will enter and exit trade. Decide which signals will be yours green light to enter. Consider that you will go if the trade starts going against you. What's your stop loss? When will you get out of this? Don't go your way. How much of your portfolio should you risk on the trade? What you will do if the market doesn't move on you're stuck in the trade? What you will do when you are in profit? You need to plan and structure every trade so that you know what to do in any scenario. Your trading plan should be complicated enough to be effective but simple enough to make scam decisions. If you have 20 conditions that must be met and many subjective, you will find it difficult if it's not possible to actually make trade. More hours doesn't mean more profit. Sitting in front of the screen for many hours can lead and diminishing returns and burnout. Sitting in front of the computer screen is a daily watching the price actions. Might sound to be fun, but I have found it can also be determinant to my performance. There is no another job in the world that will make money from you by trading your time. You can make thousands of the dollars in a few seconds, but you can also trade for 7 hours and lose a lot of capital. The market doesn't care how much time you are trading for. Day trading is often chaos and full of stress. It's so easy to lose your ability to concentrate. You can be highly motivated to day trade and have a decent strategy, but if you lack concentrations, you will have big problems. When day trading isn't essential that you learn to concentrate while exclusive a trade and monitor the market actions during a trade, it's useful to remember that the concentrations take psychological energy and your energy has its limits. If you want to maintain your focus, you must be rested and relaxed. 4 hours of concentrated trading or riches is usually the limit for the most people. Don't overdo it. More hours does not mean more profit. Value your time. You don't have to spend all day trading. Don't quit your job to become a full-time trader. Don't start with the intention of trading for regular income. Day trading is not something that you should be taken lightly. It takes years of building up knowledge and experience. I get triggered when I see influencers on the different platforms telling people to quit their jobs to do they trade stocks or crypto, showing off their expensive cars and luxurious lifestyles. You can't simply walk out of your day job to start trading. There are many traders that are successful and have full-time jobs. Remember, in trading you do not have to set salary. The market owns your nothing. Your winning strategy might stop working in a year, and your mistakes have big consequences in trading. You don't know how much money you will make or lose before any given trading day. This is the most important piece of the advice I can give you to 9 to 5 trades. Do not give your primary source of income. In general, you don't want to lose streams of income. The more streams of income you have, the more stability you have. Better income stability will allow you to trade better, as your view in the market with the less emotional attachment to money. Keep your jobs as soon as you can while you build your trading skill set. Don't rush the process. Don't believe anything you read until you have tested and tried it out for yourself. What used to work 10 years ago on the market may not work today. The strategy I use is the 4-hour time frame on Tesla may not work for you on the 5-minute chart of Bitcoin. So that's the common mistakes almost new traders. They don't understand the different strategies work on different markets. You only find out what works for you by regular testing and analysis. Back testing the most underutilized weapon of the trading. Many traders find it to be boring, difficult, and even pointless. But back testing allowed you to witness how your plan would have theoretically performed had you been trading it for the past months. With these informations, you can objectively confirm whether or not your trading plan will make you money. Backtesting is like the mirror to reality. You might have the best trading idea, but if you're backtesting it over the past few months and it's not profitable, chance are is this strategy isn't going to suddenly start working now. Likewise, if you come up with the clear idea that your thing probably doesn't work, you may surprise yourself to discover through your backtesting that it in fact does work. Of course, in the past is never indigenous of the future, or at least not consistently reliable one. But without backtesting, so you're essentially trading blind. If you found value and learned something new with us like this way, we will know that you like to see more video like this one. Until next time.